Hello trading friends and welcome back to Forex Focus, brought to you by IG. Taking a look at pound dollar today in light of recent news from the Bank of England. They met here in March and they left interest rates unchanged, which has been a common theme amongst most major central banks, but they came out a little bit more dovish than thought, causing some pretty significant downside in the pound, and we're going to cover all of it, everything from UK inflation to interest rates to Bank of England, pound dollar price action, and everything. But let's start with the most recent price action, because you see, a pretty big red bar there for the pound, and there has to be some contextualizing around this, because a lot of the information that we're about to give you might make it seem like, oh wow, the pound, why is this the market that's falling the most here in recent trade? And part of it is because the pound has been one of the strongest major currencies in the last handful of years relative to US dollar. I mean, when you look at Japanese yen, Australian dollar, and even euro, they're kind of in a relatively weaker bucket compared to the pound and the Swiss franc, and even the Canadian dollar at times being relatively stronger than those other major currencies. And so with that context, to see 140 pips of downside in this pound is really, really significant, going from above 128 earlier in the month of March to now crashing below 127 and nearing those recent lows of around 126, and we'll see if they continue through those levels. What's causing this? Recent Bank of England meeting where they kept interest rates unchanged, and this is a little bit of that, like, they keep interest rates unchanged. Interest rates in the UK are some of the highest of major global economies, above 5%, but a couple of things. U.S. interest rates are still relatively higher than the U.K.'s, and maybe it's not by much, but they are higher in the U.S. and leading to some relative strength for that U.S. dollar. But also, the Bank of England came out with some more dovish talks, and the conversation isn't necessarily anymore, who's going to hike the most, who's going to have the strongest interest rates, the strongest economy between the US, UK, Euro area, Australia, Japan, and Canada. Now it's more of a, okay, who's going to be the weakest, as most major economies are looking to normalize rates lower now, cut interest rates. And a big piece of this Bank of England meeting was that in more recent Bank of England meetings, they've had at least one central banker come out and say, hey, I think interest rates still might need to go higher. Now they have no central bankers, as of this most recent meeting, thinking that interest rates need to go higher at any point. And they have one central banker saying that rate cuts should already be here from the Bank of England, affecting UK interest rates. So definitely some dovish terms. And of course, this Forex game, again, is a game of relativity, right? And so you had the FOMC for March, and you saw the US dollar dip a little bit on what was interpreted as a relatively dovish Fed Chair Powell. But if the UK equivalent, the Bank of England, comes out and they're even more dovish than Powell, then this pound, net on net, all else equal, will lose ground to the US dollar. Of course, there are other factors, but in the last couple of days, you had the FOMC, you had the Bank of England, and now the pound is, at least for the time being, the loser of those 2 days of central bank meetings. And part of the equation here, a big part of the equation for the Bank of England, is UK inflation rates falling more than expected at this most recent reading, which was just a couple of days before the Bank of England meeting itself, probably affecting some of the conversations had between those central bankers. And this is one where the trajectory is lower, similar to the US, but the UK inflation at this most recent reading, like I say, fell more than expected. And it's falling at a faster pace than the U.S.'s inflation. You might remember most recent U.S. CPI and PCE inflation numbers have been relatively flat month over month, not really falling that much, whereas the inflation rate here in the UK fell below 3.5% from the previous 4% print. And so at that rate, you might expect to see UK inflation at the 2% target in the next couple of months here. And the worry becomes for these central bankers, okay, we raised interest rates to fend off the inflation at 7, 8, 9%, as you can see here in some of those readings about a year ago for the UK. So we hiked interest rates, and now inflation's moving lower. Great, but the soft landing that they're looking for, so to speak, you might have heard that term, is they don't want inflation and GDP growth rates and employment and all these economic data points to fall through the floor, so to speak, which is to say, if we keep interest rates too high for even a little too long, before you know it, this inflation is deflation. Employment change on a monthly basis is negative. Companies are having to lay off people, and GDP growth rates are negative as well because interest rates were too constricting for too long. And so this balance is so hard to strike. And now you might see the Bank of England cutting a little bit sooner than expected, and maybe sooner than the U.S. And that'll definitely affect this pound dollar price. Wondering how far it could fall. Well, remember that as recently as just about 6 or so months ago, this market was toying with 121. And in the last 3 years, this is a market that's been as low as 110. Even at not various points, at one point one day it got down to 105 before bouncing back. But lets you know what the market can do here for this pound. Still up at 126.5. That's relatively expensive for the last couple of years. And now why would this market continue to fall? Well, it would likely be UK weakness to the tune of, like I said, falling through that 2% inflation target, GDP growth rates and employment rates turning negative on a monthly or quarterly basis, especially if the U.S. data continues to remain relatively strong. And of course, the flip side of that coin is also there, that maybe this UK data just dipped momentarily and they'll end up being stronger, or U.S. data could dip as well. But on the current trend, most central bankers coming out dovish here in March, but the UK central bankers coming out a little bit more dovish than those in the US, and causing some pretty significant downside here for that pound.